Hello and welcome to a brand new episode of Smart Money. On Smart Money today, we talk about investing into debt funds, a basic masterclass on why you should invest in debt funds, the myths around investing in debt funds, and how to go about it if you are a beginner. Our expert today on the show is Nasser Salim, the managing partner at FlexiCapital. Nasser, thanks a lot for joining us on the show. Before talking about how to invest in debt funds, right, let's just try and bust some of the myths, because there are so many myths about debt funds, that they're safe, that my capital gets protected, etc., etc. But just I want to understand from you, what are the biggest myths about investing in debt funds?
Good afternoon, Sonia, and thank you for inviting us on this show. I think, clearly, you rightly said, there are enough myths about many investing asset classes, but I think debt today plays a very, very important role in all our portfolios. And therefore, it's very important to know. We've often heard that it's like risk-free return, it's secure, and the principal is not at risk at all. Debt as an asset class is safer than equity. We've also heard a lot of investors saying that many a times. And also, I think most importantly, they say returns are assured, which I must tell you is not the case at all. And I've also, we've also heard people talking about the fact that your capital is guaranteed. So, Sonia, here's the clarity. I think, these are myths which need to be clearly debunked, if I can say so. Debt as an asset class is binary. The risk is binary, right? If you get your money or you don't get your money, unlike equity as an asset class. And therefore, it's very important for investors to know that there are inherent risks in debt, just like the way there are risks in FDs, for example, also, right? But debt as an asset class comprises of multiple factors that you need to look at before investing, which is why we also have SEBI, which repeatedly comes out and says they've launched riskometers in debt funds. We've also had many disclaimers being put out saying that, past performances should not lead to, future guarantee returns and so on and so forth. So I think, Sonia, it's very important to understand that, and we will kind of try to address some of those as we go along.
Absolutely. And I want to take it one by one, right? I mean, let's try and bust the first myth. You said that it's a myth that debt funds give risk-free returns. So what are the key risks that are involved if I invest in a debt fund? Because the common perception is that at least my capital will be protected if I'm in a debt fund, right? You tell us, what are the risks?
So, Sonia, again, there are three inherent risks in a debt fund, right? And this could be a debt EIF, PMS, mutual fund, whichever fund you invest in. And the key risks are, interest rate risk, then there is something called a credit risk, and there's a liquidity risk. Now, let's probably explain each of these in a minute. Interest rate risk is something which is the biggest danger, because that is basically a function of interest rates. And that's why it's called interest rate risk. Interest rate yields and your the bond prices are inversely related. So, for example, Sonia, in the last few, since March of 2020, when COVID happened, we saw all central bankers push down interest rates. So, we had the RBI come in and they came in and said, we will reduce repo rates because we want to ensure that lending costs come down. Now, in a debt fund, basically you're investing, you're putting money. When you're investing in a debt fund, basically you're giving out money to a fund, which is basically giving out that money to various companies or a group of companies through these debt funds. What we have to understand is when interest rates come down, Sonia, the bond prices start to shoot up, because you would obviously want to end up getting a higher return. It's a very simple philosophy. What it says is, if I'm getting today, a bond is fetching me a 5% yield. Tomorrow, if the yields come down, if the RBI reduces interest rates, it comes down to say sub 3% to 2.5%, 4%. The people who are holding a 5% bond paper obviously start charging a premium, and therefore the bond prices shoot up. And then that's exactly what happens vice versa, which is in today's scenario, Sonia, we're now looking at an interest rate increase all over globally, including India. I mean, RBI is also increasing interest rates gradually, as we know. And therefore, an inverse relationship plays out beautifully in this case. So if you're investing in a debt fund where you're betting on a longer tenure and interest rates start to move otherwise, you will start losing money, and your bond price will start to fall. So any investing today will have volatility to the extent of losing principal on account of interest rate changes, what it was since March of 2020 to now, because we've seen a scenario where interest rates were coming down, and now they're going to go back and they started to go up. So therefore, you will lose principal.
Okay.
That's the first one. The second quick one is something called credit risk, Sonia, which is basically it's on account of a deteriorating financial credit worthiness of the companies that a mutual fund or an AIF or a PMS debt fund manager is investing in. Now, obviously, we've seen scenarios in the past, Sonia, where we've seen credit worthiness decreasing, financial stress coming in balance sheets, and obviously investors feel that, they get to know at a very later stage, and therefore there is something called credit rating, which we'll explain to you in the next few minutes, which talks about how to evaluate the underlying bonds exposure in a particular fund. And that's the second risk, which is basically if the financial credit worthiness of a company falls, they cannot pay you back the money. So therefore, there is a credit risk at play at a debt investing fund level. The third one is the liquidity risk, where basically what it basically means is that the fund manager can't meet redemption requirements, Sonia. If a bond is defaulted, which is basically if the company is not credit worthy enough to pay its commitments, because debt, I must tell you, Sonia, is a promise to pay. You're investing, and it's basically a promise that we will pay you a certain coupon or a certain rate of interest, depending on what frequency you use in terms of agreements. So it could be semi quarterly, annually, monthly, and therefore, if at the time of commitment liquidity risk is not met, that's a big risk in itself, and therefore that can impact your underlying returns, and your goal for which you may have invested may get completely haywire.
Okay, so there are a lot of risks, right? Interest rate risk, credit risk, liquidity risk, and as we've seen in the past as well, these are situations that don't only impact one fund, it impacts the entire industry, right? How can we mitigate these risks, Nasser?
So Sonia, again, as you said rightly, it's impacted industries, and we've seen these scenarios in 2020 as well. We've identified a few key metrics, Sonia, in keeping it very simple and lucid. What we've done is we've identified a few metrics basically for our viewers to understand. If you can just track those metrics and you ask those relevant questions. So the first one, I think something is what we track in all debt funds, and I think viewers must, investors must ask this question is, what is this yield to maturity? I mean, this is all over available. It's simply available at all, prospectus. You can have a chat with your advisor and distributor on this. There's something called yield. And it basically says, and what we track for ourselves is alpha generation on that yield. Now, it basically measures the number of times the fund has outperformed its stated net yield to maturity over a 3-year period, for example. I mean, in this case, I'm telling you a 3-year period. And funds with a higher probability of outperforming its yield, which is the coupon that you're getting, are ranked usually better, right? Now, what we have to understand is that this yield concept is nothing but a special measure, Sonia, of the total return expected on a bond each year, and a bond's internal rate of return, basically, it's measured through something called the internal rate of return. And this bond each year, if the bond is held until maturity. So basically what we're saying is it's a measure of the total return expected on a bond each year if the bond is held until maturity. As simple as that.
Okay.
And it's expressed in an annual rate, or it is denominated by something called internal rate of return, IRRs, which is essentially a bond's internal rate of return if held to maturity. Now, it's also called the book yield or the redemption yield, because that's the yield at which you will receive your money. The promise that I just spoke about, Sonia. And it obviously differs from something called nominal yield, which is usually calculated on a per year basis. This is the yield to maturity is at maturity, and nominal is basis on every year yield. So that's one of the few things that we must fundamentally track when we speak and look at debt funds. Oh. The other one is, again, we just spoke about that, Sonia, is something called credit rating. And this is a very, very interesting perspective because, we've seen, and we've put a small case study for us, of our viewers as well, to kind of explain the logic behind this. Basically, all bonds have a credit rating. They not all, but they should have a credit rating, ideally. And it's nothing but a rating is nothing but a score that is used to judge the quality and the credit worthiness of a bond, which I just spoke to you about. Now, simply put, the higher the credit rating of the holdings, usually lower are the yield to maturity. So it's very simple. If you have a higher a higher credit rating, the yield is normally lower. If you have a lower credit rating, because a lower credit rating means basically you're investing in bonds, Sonia, which are susceptible to higher default risk, if I can say so.
Sure.
Or which may have possibly a lesser credit worthiness as compared to something like a higher credit rating. So a higher credit rating could range from, could, for example, starts at AAA. And the lowest could be BBB minus, for example, Sonia. So obviously the logic is very, very simple. The ratings are published by credit rating agencies regularly, and these are used by investment professionals like us to assess the likelihood of the debt which will be repaid. So again, a very, very strong barometer of metric that we need to use for debt funds.
Oh, absolutely, absolutely. Credit rating, looking at credit ratings is the most important, I guess. Any more metrics that we can use to track and mitigate risk?
Yeah, so the other quick one is something called modified duration, Sonia. And modified duration basically measures the change in the value of a bond in response to a change in 100 basis, which is 1% change in interest rates. So basically, in a nutshell, what it tells us is something called modified duration. And as a bond's maturity increases, duration increases, and as a bond's coupon and interest rates increases, its duration decreases. So, for example, if one has to invest in a particular fund where you have a horizon of, say, investing for 3 years, you should ideally invest in a fund which has a lower modified duration. Because a fund with a higher modified duration, Sonia, will have a higher volatility, which is and so in a rising rate, which is currently in a rising rate environment, if an investor purchases a fund with a high modified duration, he would have to face higher mark-to-market losses as compared to a shorter duration fund. So that's the relevance of modified duration, which is again a very, very important factor.
Okay, this is very helpful. Let's do one thing, Nasser. Let's take a bit of a commercial break. But don't go anywhere. We'll come back in just minutes from now to continue our discussion on investing in debt funds, all the pros and cons, debunking a lot of the myths, etc. All of that lined up in just a bit. Stay tuned. Welcome back. You're still watching Smart Money on CNBC-TV18. We're talking about debt funds, and we're here to debunk a lot of the myths and tell you how and why you should invest in debt funds. We have with us Nasser Salim, the managing partner at FlexiCapital. Nasser, thanks a lot for staying with us on the show. I want to talk a little bit about fund managers of debt funds. So generally, when you pick equity funds, you are told to sort of review fund managers, and that's an important aspect, find out what the fund manager's style is, etc. But how do you find out the track record of the fund manager in a debt fund?
So, very interesting question again, Sonia. So basically, what we need to look at is clearly the number of years that a fund manager is paying in debt as an asset class. It's the first and foremost. And one is that. Second thing is what kind of the team that he's kind of employed and what is supporting his research. I think the key fundamental attribute required for a debt fund manager is something called consistency and the patience to deliver. And the fact that, he's not taken very aggressive calls when it comes to credit ratings and credit calls. I think, and I also must say this, Sonia, very loud and clear, if I may say so, that the fund manager will also, by virtue of his fund management skills, will also ideally tell you some ideas about which asset management company that he would ideally like to work with, in the sense that an aggressive asset management firm will possibly not have a very non-aggressive fund manager on debt. So therefore, I think it's very important to kind of match both the fund manager's style with the asset management as well. So for example, there are many asset management companies in the past where we've seen they've taken some aggressive bets on credit, as against some which have not, and those have played out very well. So that's the one of the few key things one needs to look at it from a fund management perspective. And the other quick thing is, Sonia, is that you're buying in debt funds broadly for that asset allocation discussion, Sonia, for that investors do or clients do. Basically, it's done for a strategic reason, for a purpose to get that yield. And it's ideally for a minimum of 3 years also because, debt funds ideally give you that indexation benefit. So if you're putting in a fund for 3 years as a strategy, it may be worthy of at least checking a fund manager's consistency and track record for a bare minimum of at least 6 to 8 years, as in terms of getting a clear view of how he's performed in both mostly in both interest rate scenarios, where a rising interest rate scenario and a decreasing interest rate scenario. So that is something which will kind of give you.
Is there any platform, any website that tracks the fund manager's performances in specific debt funds? I mean, how do you do this kind of research?
So, Sonia, these are all available, I must tell you, in public domain search engines. There are distributors and RIAs and advisors who use professionally managed, search engines, which give us a clear indication of what is the style of the fund management. Has the fund manager been in terms of number of years? There's something called a manager tenure, and what is the style that he's been used to. So there are many public platforms available, reliable public platforms available to use those and to get a score.
Okay, let's come back to the metrics, right, that we were tracking on how, what are the different metrics in order to gauge whether a debt fund is good or not. Anything that we left out? I mean, something that you'd want to discuss, which is a crucial metric?
So I have two very important ones. Number one is the average maturity, and there's something which I like to introduce in your show called the ultimate Z score. Those two are very, very important because the others are all very, essentially common to the entire fund management theory. So starting with average maturity, Sonia, this is again a very, very important parameter like modified duration and credit scores we just spoke about. So an average maturity is basically the weighted average of all the current maturities that are in a debt security at the fund level. These are weights are the percentages of holdings of each security in the portfolio. That's broadly it. And what average maturity tells you is basically helps investors understand the approximate time in which the bonds in the fund will mature, basically, Sonia. And depending on this duration and the investor's financial goals, which is very, very important here, the investor can choose to invest in which funds that mature in the appropriate time to avoid mark-to-market losses. For example, if I were to invest today with an average maturity of a fund, which is, say, close to about 4 years, but I need funds in, say, 1 year, that's a clear mismatch in terms of your average maturity number and your goal to kind of meet that objective. So therefore, that's very, very important for investors to match their goal with the average maturity of the fund, and therefore it's an important parameter. The second one, I would like to shed possibly a minute or two on, Sonia, is something which is, it's not easily available. So this is something which you have to, hunt out and dig out. And this is called the ultimate Z score. It's a very interesting score, Sonia, and what it basically tells our, investors is that it analyzes performance of bankruptcy, basically the probability of a company going bankrupt. So basically, this kind of predicted the major 2008 issue of Lehman Brothers and the financial crisis that we saw in 2008. And what it basically tells you is it uses broadly 5 metrics. It uses profitability at an entity level. It uses leverage as a metric. It uses liquidity, solvency, and it basically predicts whether a company has a high probability of being insolvent or not. As simple as that. And a score, and it's got obviously various parameters in terms of scoring. And I must tell you that Professor Edward Altman, he's the gentleman who developed this way back in 1967. And today, and originally it was actually only for manufacturing companies, but today he launched something in 2012, an upgraded version of the Ultimate Z score, which is basically called the Ultimate Z Plus score. And what it does is it evaluates both manufacturing and non-manufacturing companies in terms of corporate credit risk. And this is something which can be done for a lot of our investors who are investing in single bond papers, in single bond issuers. It's important to kind of go through the numbers to understand a score of greater than 2.99 is safe from bankruptcy. Sonia, I must tell you, a score of 0, for example, is a loud shout, and a score of less than 1.8 carries a high risk of bankruptcy. So, this is a very, very important parameter. And I must tell you, Professor Edward Altman went through over 250 companies in analyzing their balance sheets, in understanding why they were distressed, and therefore the score has come up. So this is something which one should kind of look out for and try to get access to.
All right, I think we need a special show, right, to understand this Altman Z score. But it's very important. I mean, if it helps you tell whether a company is going to hit bankruptcy or not, that's the most important internal to track, especially when you invest in debt funds. But thanks a lot, Nasser. We've run out of time, not out of questions. Very good learning on how to approach debt funds and the do's and don'ts. So thanks a lot for joining us. With that, it is a wrap on this special edition of Smart Money. Thanks a lot for watching. Have a great weekend.